Hi, I'm Samir Jain. If you invest in master limited partnerships, I think you'll like this video. So at Active Allocator, we continue to augment our system, add new asset classes in response to client needs. So one such asset category we recently added is master limited partnerships, MLPs. It was a non-trivial exercise, I confess, to model a MLP. So in undertaking that exercise, I grew convinced that MLPs are a good fit for high net worth client portfolios. And for those of you who haven't invested in MLPs, I guess a primer may be useful. So MLPs are hard asset plays which generate predictable inflation hedged cash flows because they hold long-term physical infrastructure assets. These are regulated by SEC. They trade on NYSE, NASDAQ, and the MX. And because these are structured as partnerships, they are not taxed at the entity level. They exist as quasi-regional monopolies. They have high barriers to entry, given significant upfront investments needed to create their underlying assets. They have low operating costs, and they face relatively inelastic demand. So think infrastructure. Historically, legislative and structural barriers have kept mutual funds and large tax-exempt institutions who incur UBTI as MLP distributions are treated as a non-qualifying source of income away from this space. So in some ways, and this is a crude parallel, they are much like REITs, for they distribute much of their available income. And they are loosely correlated with other asset classes, including with REITs. MLPs can be an effective substitute to provide partial tax-deferred cash distribution and running income. They seem to have a large room for future growth. And the drivers of growth are growing and predictable energy consumption, the need for new oil and gas pipelines, if not right away, certainly in the medium to short term, and the new LNG terminals, acquisitions, organic growth that's happening in the energy sector. Moreover, lower comparative yields from other asset classes make MLPs higher yields even more attractive. Also, with corporates resizing their balance sheets, I also foresee a migration of qualifying assets from corporate balance sheets to MLPs. So the pros are, as we said, MLPs have weak historical correlations with broad equity and commodity market indices. They can serve as a valuable class for portfolio diversification and for yield enhancements. And since their future revenues and in energy haulage tariffs are often contractually linked to future producer price indices, they can be a valuable long-term inflation hedge. And many people are beginning to worry about inflation in response to what has been a very lax monetary policy. So these are not taxed at the entity level if they generate 90% plus of income from qualified sources. And their periodic distributions reduce their original basis. And depending on the amount of distributions MLP investors can defer, probably 70 to 90% of income received until they sell them, they pay out their cash flows and they have to return to capital markets at periodic intervals to raise capital for new projects and for growth. And I guess this imposes greater self-discipline to meet investor expectations. The cons, the flip side, I guess for non-US persons, direct investment in MLPs may subject them to US tax filing. And I'm no expert on tax, but that's something that I read somewhere. And a 10% withholding tax upon sale. For US persons, direct investing in MLPs will result in receiving K1s, probably not a big deal, instead of 1099s, and they require filing returns in each state where MLPs do business. Also, registered investment companies may be subject to UBTI, as that income is treated as non-qualifying. So the participant space for MLPs has been changing with the newer types of qualifying assets with greater sensitivity to commodity price being structured as MLPs. For example, I came across a new category of riskier pure public play GP entity which receives carry from a fund, and these have started to be structured as MLPs too. So I suggest that investors carefully scrutinize the underlying MLP holding, much as they would in any stock selection before they decide to invest. Another thing is liquidity has been lesser than large cap stocks traditionally, though in their defense, with their enhanced popularity, this is continuing to improve. And of course, like any other business, they face regulatory risk, changes in demands, and therefore throughput, supply side disruptions, macroeconomic changes in the tax code, and ability to grow cash flows. So overall, we've been able to model them and include them as an asset class within active allocator. And I think that they do have a place, especially in high net worth portfolios, because they provide a high equity yield income, and they provide valuable tax deferral advantages. So if you've been thinking about including a diversified pool of MLPs, do check us out at activeallocator.com. Take a test drive and model your own portfolio. Get in touch with me. Thanks for listening in.